All right, guys. So I've gotten a lot of requests to do a portfolio breakdown, and I've gotten a lot of recent support, which I want to thank you guys first. All the likes, all the comments, all of it really helps out. I want to be very clear about the intent of the video, though. This is not a flex, it's not financial advice, and it's definitely not something I think anyone should be copying. The only reason I'm making this video is because people have asked me how I think about investing, conviction, and risk. And the easiest way to explain this is by walking through my actual portfolio. I'll show you guys the numbers briefly for transparency, but the focus today is going to be the why, the risks, and the mistakes. So, not the outcomes of what has happened in the portfolio, just kind of my thought process going into it. Before I can put anything on screen, I think some context matters. I started working when I was 16 years old because everyone's going to ask how I have this huge sum of money. And for a long time, I was basically working every hour I could. I mean, there were periods where I was working close to 80 hours a week, including while I was at community college. And that meant a lot of weekends, early mornings, and not much free time. I mean, I'm not really a party guy, but also it just wasn't a lot of fun. But it showed me how I was going to save aggressively. And at the same time, I've also been very fortunate because my parents have allowed me to live in home, which has made a huge difference for me personally. I want to say that clearly because pretending otherwise wouldn't be very honest of me. So this portfolio is a huge mix of hard work, saving aggressively, taking a couple of good risks, and having a strong support system that has helped me out in the last couple years. And I'm extremely thankful for that, and I don't take it lightly at all. So I want to make sure I get that out the way. I'll put the portfolio up on screen now just for context. I'm going to talk about it mostly in percentages because that's actually how I like to think about it. And when you look at it, my portfolio, you'll notice it's very concentrated. So let me zoom in here for you guys on the top couple positions. As we can see here, ASTS nearly 80%. And that's very intentional. And I've researched a lot of stocks and a lot of the market, but it also comes with a lot of real risk, which I'm fully aware of. And I want to show you guys in this video. So let's move on to the most obvious stock I have, and that's ASTS. And this makes up roughly 80% of the portfolio, which is not normal. I do not advise it to anyone and not something I would recommend. And it's not something I would do if I didn't fully understand the downside. So the reason it's this large is because I view ASTS as a binary but asymmetric opportunity. So if this company succeeds in building a direct to device satellite network at scale, which as we know Starlink has been trying to do, and they are valued at almost $800 billion, this type of scale doesn't make it just another tech stock. It will become a global telecom infrastructure which controls really on the back end most things, because as we know, with all the partnerships ASTS has, it's nearly 3 billion customers worldwide, and that's a very different outcome than what the market typically prices early stage companies at. What organically attracted me to the stock was the combination of the technology, the partnerships they had. I mean, Verizon, AT&T, I could keep going on. And it's a huge problem that clearly exists. I mean, if you guys have gone hiking, if you've gone on a plane, gone on a boat, you know that there's connectivity issues pretty much everywhere, even in some very populated area. And this affects billions of people which still lack reliable connectivity. And ASTS is trying to solve that without special hardware. Now, I want to be very honest about the risk, and execution risk is probably the most massive one because this is a huge timeline and they're on a time constraint a little bit, trying to get the service up as quick as possible. And this is coming with regulatory and technical challenges, which they have done well so far, but we want to see what will happen in the future. This has not been a straight line investment. As we can see here, it was down for almost a year where I started investing in June of like 2024 into ASTS at around $9 a share, and now it's at $113. But there was about a year where I was checking it every day, and it just wasn't moving, and I was like, oh man, I should just sell this, buy a different stock. And a lot of people see the gains today, and they don't see where it comes from immediately. And these came from staying invested consistently, staying, not trading. One of Warren Buffett's greatest quotes, in my opinion, is that the money is made in waiting on the stock. It's not in the trading of the stock. So I constantly reassess this position. It's if execution materially breaks, if the funding dries up, or if partnerships deteriorates, I would absolutely rethink this allocation. This isn't blind faith for me. It's conviction that is paired with a huge risk tolerance, especially because of how young I am. My thought always has been I don't want to work all my life. I could obviously invest in growth stocks like Google, Meta, maybe some Adobe, and get that maybe 20% a year, which is obviously great. I'm not going to lie, but I've always wanted a higher risk for my personal preference, and that's why I want to put here. And assuming my conservative price prediction for 2030 is 671. And as I was saying, they have around 2.8 billion customers inside of their range with all the different carriers. So assuming a 10% adoption rate, which is very common in this industry, we get 280 million productive users with the average price for the service around 2 to 4, I think. So I went right in the middle at 3. Other revenue I put in for government contracts and anything. Operating expenses 300 million seems very fair once they are up in the sky. 25x multiple just because of the growth possibility, but also telecommunications are roughly inside that 15 to 20 range, and they currently have 370 million shares. So that brings us to this price. If you want to look through the numbers here, but to be exactly clear, if ASTS fails, this portfolio takes a huge hit, but I'm comfortable with that risk. And that's what makes this not a safe portfolio, but it makes it my portfolio. So outside of ASTS, I do hold some exposure to the broader market, and this is with VTI and VXUS. These together represent that I know that there isn't, I don't know everything about the market. I've researched, I know that 99% of people that invest in single stocks end up losing money, and that these are not exciting positions, but they keep me grounded and reduce overall risk. And I recommend for everyone, if you're planning on retirement or anything, the Roth IRA is something you really have to look into because the money you deposit has already been taxed. So once you turn the age 60, you'll be able to take this money out, no tax implications, and this is a huge thing to open up some money. And it's where I have most of these VTI and VXUS in. Outside of ASTS and the index exposure, this is where the portfolio gets more interesting and also where discipline matters the most. And these are what I like to call the growth stocks. These are positions where I see meaningful upside if the thesis plays out, but I'm very aware of the risks. So none of these are meant to make or break the portfolio. They're sized so that being wrong is survivable and being right will actually matter a lot in the future. So the first one on the list is Poet Technologies. This is a company focused on photonic integration, which if it sounds like a huge word, but it's basically just AI. What the back end of AI and what makes it compelling is the problem it's solving. So as AI scales, data movement inside data centers becomes a huge bottleneck, and this power efficiency, bandwidth, and latency will matter just as much as the computing power. So Poet's approach integrates multiple optical components at the wafer level, which could lower costs, improve yields, and make high volume production more realistic. So, what keeps this a small position is timing and execution. Hardware adoption is slow early, and revenue ramps can take longer than expected, especially as we wait for more partnerships to come. But if Poet becomes part of the optical backbone of the next generation data centers, the upside will be very significant here. If not, this could take a couple years to play out, but I'm ready to take that time and wait for it. So next stock on the list is one you guys probably saw, Rocket Lab. I have about a couple percent inside this. I invested at $4 a share, so it became a huge part of the portfolio, but I still have the same view. The long-term value comes from vertical integration, and this is from launches, satellites, space systems, and defense contracts. I mean, I could keep listing different things, but I think you guys understand a little bit. That said, this is very capital intensive. Margins will need to improve as time goes on, and execution matters a lot. But if we look at companies like SpaceX, you can see why this valuation makes sense and why it can grow in the future, but it's still a smaller allocation for me. Next stock on the list is Microvast, and this is probably one of the most misunderstood positions here, in my opinion. I made a video on it in the past, and this stock got kind of crushed down all the way from $7 a share down to 3 again after the EV battery hype cycle broke. But this isn't a concept company. They have real products, real customers, and global manufacturing. The key question here is operating leverage, and they are trying to integrate into a lot of public work systems, which I think will be crucial for the stock. And if volume increases over the next coming months and manufacturing stabilizes, the margins will improve and we will see a huge increase in share price, in my opinion. The risk is obviously execution and capital management. So if costs stay high and demand weakens, the thesis will break. That's why it still stays small, but I have some in here. More recent position that I've been having an eye on for a while is Rezolve AI, ticker symbol RZLV. This is an early stage AI monetization story, and skepticism is one of the biggest parts of the stock. It's 50-50 whether you love or hate the stock, and revenue is still developing, and a lot depends on execution. So for a company that only reports revenue once every 6 months, a lot of people have thought that the numbers that they are providing are not true and that the partnerships are somehow fake. What makes this interesting, though, to me, is that Resolve is focused on enterprise commerce. And with already 650 customers, AI can directly drive conversion and revenue. And if this scales, it becomes high margin software. And if it doesn't, obviously there will be downside, but positioning will, for me, reflects that. So next stock on the list is EOS Energy. I bought in at around $3 to $4 a share, and this is a small position tied to grid scale energy storage, which if you guys have looked into it, this is about infrastructure demand over time. For energy, pretty much grid reliability, renewable integration, and long duration storage is going to be crucial over the next coming decades. And that's why I personally have positioned myself inside this stock. And with the funding and execution risk, I think it will stay a smaller portion of my portfolio, but I see a lot of demand coming to this type of market in the future and a lot of potential still here. Next stock on the list is also TMC, the metals company, which I've talked about a lot. I got lucky enough to get in under $1, and it's a big bet on deep sea polymetallic nodules as a future source of huge materials like nickel, cobalt, copper, and other materials like that. And as we know, the US is trying to get these materials at any cost possible. I mean, if you've been watching the news, you know about the Greenland deals, you know about all the little bit of grimy stuff America's trying to do to get as much resources. So the upside here comes from growing demand for these materials, and the risk comes from just regulation, environmental concerns, and execution. But this is a pure optional play. If it works out, great. If not, it doesn't damage the portfolio. I recommend people look into it at least and have their eyes on it. The key thing to understand, in my opinion, is that not all of these need to work. If one or two of these play out well, these stocks I just talked about, these growth ones, there will be meaningful upside. And if some don't, the damage is limited depending on how you position yourself. So that's how I like to think about these growth stocks. And the remaining positions are pretty small. I mean, we got Amazon, which is a pretty household name, RCAD, which is drones, which I recently sold. Pretty much 80% of the position on there to move it into Resolve, or which I've made a video about. It's pretty much AI trucking, Archer Aviation, which is AI planes. As you can see, I'm very tech invested. I believe the future is moving very quickly, and I think a lot of developments are going to be made in the next decade. And I just want to be investing in the companies backing that. Then I got Bear, which I've also talked about, but it's just a firefighting company, wildfire company, and they have been growing well. The bottom line of the company has been doing very well, so that reflects my investment there. Texas Roadhouse, I mean, how can you not love the Texas Roadhouse? And Recursion Pharmaceuticals, which is a smaller position, but I'm still looking into it more and more and thinking about upping the position, but we will see there in the future. Some of these I wouldn't start today, and that's okay because a portfolio evolves over time. Like, I wouldn't tell you guys to go buy ASTS at 113 today. I'd maybe wait for a pullback, maybe not though. But I want to end by saying that this portfolio is not a success story. It's just a snapshot in time, guys. There's been a lot of luck. There's been a lot of volatility. There's been a lot of mistakes on my end, a lot of stupid stuff I've done, a lot of great stuff I've done. And I don't think I even deserve to have this big of a portfolio, at least definitely due to some of the stuff I've done personally, mistakes on the market, different stuff like that. I'm grateful for the opportunity I've had, the support around me, and the ability to even take risks like this and talk to you guys about stocks. If you disagree with my positioning, I actually want to hear that. Drop it in the comments. Of course, a lot of people are going to come here and tell me I could just invest it into VTI or QQQ for the rest of my life and live off like for 40,000 a year, but let me know what risks you think I might be underestimating. I appreciate you guys watching, and I'll see you guys in the next one. Peace.